Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. Today we are going to be valuing Berkshire Hathaway stock. And it's a really interesting one to value because the previous video I made on how to value a business where I valued Apple stock isn't going to work at all. And one of the reasons that's not going to work is actually due to a recent accounting change. So one of the big accounting changes that applies to Berkshire Hathaway massively, and also a few other companies, Google actually falls into this category to an extent as well, is that any gains or losses in marketable securities or sort of shares of other businesses that that company owns, any of those gains or losses actually have to be attributed now to earnings for that company. So, for example, if Warren Buffett goes out and buys Apple stock at $150 through Berkshire Hathaway, and Apple stock then goes to $200, they have to actually report that $50 change as earnings, which is something that has never been the case in the past. And the same happens if Buffett buys at 150 and it goes down to 100. He has to actually report that as an operating loss, even if he doesn't sell out of that Apple position. So the effect that that has on companies like Berkshire Hathaway and again like Google to a certain extent is it makes their earnings very volatile. So even though they're not necessarily selling these stocks, as the stock market goes up, Berkshire Hathaway's earnings now look enormous, and as the stock market goes down, Berkshire Hathaway's earnings look minuscule and they may even go negative. So it's really not reflective of the actual underlying business performance. If you look at the cash being generated by Berkshire Hathaway, it's actually extremely consistent and grows over time. So I'm going to show you a different sort of valuation technique, also from Phil Town, just like the first one, and that's going to be looking at an 8-year payback time of cash flows from Berkshire Hathaway. So just before we get into that, I've got a quick sort of chart here up on the PE ratio of Berkshire Hathaway and the earnings history of Berkshire Hathaway. So you can actually see in late 2018 when the stock market had quite a large correction, we saw a huge drop off in earnings from Berkshire Hathaway, and we saw the PE ratio do some crazy things. So it was at sort of 24 in 2017, it went right down to under 10, and then it went up to 126. So earnings and PE ratios just aren't going to work, unfortunately, for Berkshire Hathaway. But nonetheless, we've got another option. We've got payback time on cash flows as a method that we can use to value the Berkshire Hathaway business. So the place I'm going to start is I've come across to the Wall Street Journal, and I'm going to grab a figure here called net operating cash flow, which currently reads $37.4 billion. Then going to come across to my spreadsheet, and I've got a bit of a spreadsheet set up here to work out a payback time, and I'm going to start by adding 37.4 billion as our 2018 figure to sort of look forward and make an assessment of a payback time on this business. So just a bit of background on where the payback time method actually comes from. Like I say, it comes from Phil Town. And it's sort of a look at what a willing buyer and a willing seller will meet in the middle at in terms of a valuation on their business. So if I'm going out and buying a business, I obviously want to get my money back as soon as I possibly can. So in a perfect world, if a company was producing, say, $1,000 of cash flow a year, I'd want to get, I'd want to pay as little as I can for that business. In a perfect world, I'd maybe pay $1,000 and I'd get all my money back within a year. That would be great from a buyer's perspective, but from a seller's perspective, no one is going to sell you a business at 1 times the annual cash flow. They would be better off just sitting there on the business themselves, get that exact same amount of money come to them from the business, and then they've still got the business again for next year, so they'll continue to get that $1,000. But at the other end of the spectrum, I'm not going to buy a business if it's selling at, say, 1,000 years worth of cash flow. I'm not going to get my money back for 1,000 years in that situation, so why would I put my money out towards that investment? That just doesn't make sense. It's not a high enough return on investment. So where we end up is somewhere in the middle of that sort of 1 in 1,000. when there's a willing buyer and a willing seller, and for whatever reason, that number always tends to be about 8 years. So that's a pretty standard sort of payback time. It's a good return from a buyer's perspective, and it's a reasonable rate to sort of sell your company at from a seller's perspective. So that's why I've got 8 years. So for Berkshire Hathaway, we've got a 2018 operating cash flow of $37.4 billion. I'm going to grow that cash flow out over the next few years, and this is a figure that will come from your own research. If the business doesn't have any growth in earnings, or it even has shrinking earnings, you may have to make some adjustments for that. But in this particular case, I've assumed a growth rate over here of 9%. So I'm going to work on 9% a year. Again, this is not financial advice. Don't take this as advice to buy or sell shares of Berkshire Hathaway. But this is a method that I'm going to use, and this is the growth rate assumption that I'm going to use for this example. So in 2019, if we want to grow our earnings by 9%, we will have our initial earnings, sorry, I shouldn't be saying earnings, we will have our initial cash flow of $37.4 billion. We're going to grow that by 9% for the next year. So that is going to be a formula I can just set up here. I'm going to lock in that growth rate, and that will give us an operating cash flow the following year of a little over $40 billion. And I'm going to drag this down right through 8 years. So I've got 8 years worth set up there. And if I add those up, so just go equals sum and highlight all of these 8 years, then I get an 8-year operating cash flow or 8-year payback time of $412.4 billion. So that's our payback time for the earning capacity of Berkshire Hathaway. But there's actually one more adjustment I'm going to make for Berkshire Hathaway, which again is a reason I'm using this. It's a really cool example of something called excess capital. So when we go out and buy a business, we are looking to buy the part of the business that throws off cash to us. So in the case of Berkshire Hathaway, we're buying the insurance companies, we're buying See's Candy, we're buying the dividends flowing in from Coca-Cola, the dividends flowing in from Apple, the cash that's essentially coming into that business all the time. But one of the things that we're not looking to buy is sort of excess capital and a big pile of cash that Warren Buffett is currently sitting on. So Buffett's sitting on so much cash at the moment that it actually makes up a pretty massive percentage of the overall market cap of Berkshire Hathaway. So I'm also going to add that into our equation. So for that particular figure, I'm going to come over to Yahoo Finance for Berkshire Hathaway. I'm going to scroll down and see total cash of $114.17 billion. So let's add that in, 114.17 billion. So an estimated market cap is literally going to be, or an estimated sort of total value for Berkshire Hathaway is just going to be those two figures added together. So our 8-year payback time plus the sort of free cash we're essentially getting when we buy Berkshire shares. And that comes out to $526 billion as a market cap, as an estimated sort of intrinsic value using this cash flow method. So if we compare that to the current market cap of Berkshire Hathaway, the current market cap, if I just scroll up here, is currently $496 billion. So we're not too far off in our calculation. We actually think it might be even worth slightly more than, or I think it might be worth slightly more than what it's currently trading at. So starting to get a little bit of a margin of safety, but obviously not a huge one. But that's where I've come to with a value. So the final part of this evaluation is converting that market cap figure to a per share figure. Obviously, you're not going out and buying the whole business of Berkshire Hathaway. You're buying shares. You're probably also not buying the $300,000 A shares. You're probably buying the B shares. So I'm just going to pull up Berkshire B, and I'll run you through a quick calculation of how we can convert that market cap into a per share value for Berkshire Hathaway. So what we're going to need to pull from Yahoo Finance again here for the Berkshire B stock to figure out the actual per share value from our payback time is two figures. So first we're going to need the per share market price, which is $202.60, and we're also going to need the current market cap. So if I pull over 202.6 and the current market cap of 497.81, we can actually work out the number of shares in billions. The next step is going to be to simply divide these into each other. So if we divide the market cap in billions by the share price, that's going to give us 2.457 and so on, which is actually the number of shares in billions. And then that just leaves us with one final step, which is to divide our market cap in billions by our number of shares in billions. Hit enter, and that is going to give us an intrinsic value per B share of $214.33. Obviously, there's some room for error, so don't get too caught up in the exact, dollars and cents. There's room for error, and that's again one of the reasons why we always buy with a margin of safety. So even though this is trading at $214, again, we're going to want at least a 30, 40, ideally 50% plus margin of safety from that. If we can pick up companies at that sort of price, we're going to get big returns. So always look for a margin of safety, but that has at least given me a good estimate of Berkshire Hathaway's value based on the cash that it's producing. And it's a really good method to use in a case like Berkshire Hathaway, where earnings just don't work for things like discounted cash flows in the previous method that I used. Earnings are really just not an accurate picture of what Berkshire's doing anymore because of those accounting changes I spoke about earlier. So this is a better option we've got. Look at the cash flow, look at the underlying business of what this company's actually producing, and use that information to put a value on Berkshire Hathaway. So I hope you enjoyed the video. If you did, please drop a like. It really helps out with the channel. If you enjoyed these valuation videos, let me know. I'd love to go through some more kind of stock valuations. So if you've got companies you'd like to see or questions you've got on these different methods, definitely drop them down in the comments below. But that's all from me today, and I hope to see you in the next one. Cheers.